Hey, welcome! Today, we are diving headfirst into the stock market. Specifically, the language it speaks. It can seriously feel like a secret code, just full of acronyms and numbers. But don't worry, by the end of this, you are going to have the key to crack it wide open.
I mean, you've seen those screens, right? Just packed with tickers, prices, weird letters, and it is so easy to feel totally overwhelmed. Your eyes just glaze over. What does any of it mean? Where do you even begin? Well, that's a super common feeling, and it's exactly what we're going to clear up today.
And to do that, we're using this awesome guide as our source material. So, think of this as our official decoder ring for today. It lays out all the most important terms you really need to know, and we're just going to walk right through them, one by one.
Okay, so here's our game plan. We'll start by kind of framing our journey, then we'll dive into how to figure out a stock's value, how to measure a company's performance, and then check on its financial health. And finally, we'll pull it all together.
So let's get into it. This isn't about just memorizing a bunch of definitions. It's about learning a whole new language, the language of finance, so you can turn all that confusing data into actual, useful knowledge.
All right, first up, let's talk about maybe the most fundamental question for any investor. What's a stock really worth? This whole section is about figuring out if the price you see on the screen is actually a fair deal.
And we're going to do that by looking at three key terms: CMP, PE, and PB. Yeah, they might look like alphabet soup right now, but I promise they're about to make a whole lot of sense. So CMP, or current market price, this is the most straightforward place to start. It's basically the price tag. It's the price of one share of a company at the close of the most recent trading day. Simple as that.
But here's the thing, a price tag by itself doesn't tell you much, does it? A $500 stock could be an absolute bargain, and a $5 stock could be wildly overpriced. So the real question is, how do you figure out its value? And that brings us to the PE ratio. Now, according to our source, this is probably the single most important number for figuring out a stock's value. It gives you context by comparing the price to the company's profits. Now, generally, a lower PE might suggest a cheaper stock, but context is everything here. A fast-growing tech company is naturally going to have a much higher PE than, say, a stable utility company.
Another really powerful tool is the PB ratio, or price-to-book value. So instead of looking at earnings, this one compares the stock price to the company's net worth. Basically, what would be left over if the company sold all its stuff and paid off all its debts.
Now, what's really cool here is the difference between the two. While PE is used pretty much everywhere, the PB ratio is especially useful for companies that have a lot of physical assets. Think banks or big manufacturing firms. It just gives you a different, more asset-focused angle on what a company is worth.
All right, we've talked about value. Now let's pop the hood and look at the engine. Is the company itself actually performing well? I mean, are they making any money? To answer that, we're going to decode three more terms: EPS, sales, and profit, using something called TTM, and a great one for efficiency, ROCE. So remember we mentioned earnings per share when we talked about the PE ratio? Well, here it is. EPS tells you exactly how much profit the company is making for each individual share out there. A consistently growing EPS is usually a really good sign of a healthy, growing company.
Next up, sales and profit, but with this really important little detail, TTM. That stands for trailing 12 months. And why does that matter? Well, looking at a full year of data smooths out any weird single-quarter bumps or flukes and gives you a much more reliable picture of how the company's really doing over time. Oh, and this one is fantastic for judging how effective a company's management is. ROC, or Return on Capital Employed, basically asks a simple question. For every single dollar the company invests in its operations, how many cents of profit does it get back? A consistently high ROC often points to a super efficient business with a really strong competitive advantage.
So we've covered value and performance. But there's one more huge piece to this puzzle: risk. How financially stable is this company? Let's check its vitals.
A really quick way to do this is with the DER, or debt-to-equity ratio. This key metric shows you how much a company relies on borrowed money versus its own money. Now, a really high DER could be a red flag, suggesting higher financial risk. Of course, what's considered high can vary a lot depending on the industry.
And finally, let's look at a little price history. The yearly high and low show you the stock's trading range over the past 52 weeks. A huge gap between the high and low might suggest volatility, while a really narrow one could mean it's more stable. It's just valuable context for all the other numbers we've been talking about. Okay, wow, we have covered a lot of ground, and we have decoded a ton of terms. But here's the most important part. Understanding that none of these numbers work in isolation. It's time to build the full picture.
And our source material says it perfectly right here. You have to use these numbers to get a holistic picture. Think about it. A low PE ratio might look amazing, but not if the company has crushing debt, right? Which you'd see from its DER. You have to connect the dots.
So here it is, your brand new decoder ring. We've broken the code down into these key categories. You can assess value with PE and PB, check performance with EPS and ROCE, measure financial health with DER, and understand the context with its price history. And that is the ultimate takeaway. This isn't just about math. It's about interpretation. Every single number is a clue, and when you put them all together, they tell you a story about a company's past, its present, and its potential future. You now have the tools to start reading that story for yourself. The financial world is no longer written in some foreign language, so the only question left is, with this new understanding, what company's story are you going to explore first?